Welcome everyone to the closing panel of this year's CSAE conference. This closing panel is concerned with the challenges that many countries are facing in managing external debt or sovereign debt more generally. And a lot of what we're going to do, I think, picks up on a number of the themes that Abebe introduced in his keynote speech yesterday. My name's Chris Adam. I'm an associate at CSAE here in Oxford. And I have three panelists. Rachel Turner, to my immediate right, is the Director of International Finance at the FCDO in the UK government. Next to her, Abebe, as I suspect everyone was here for the keynote yesterday, but just to remind you that Abebe is the Director of the Africa Department at the International Monetary Fund. And on my far right is Gregory Smith. And Greg works for M&G Investments as an emerging market fund manager in the City of London. But before that, worked for the World Bank in Zambia, and is the author of a book that was published a couple of years ago with a very catchy title, which I think does Stefan's as well. It's called Where Credit is Due, and it's about, the subtitle is How Africa's Debt Can Be a Benefit, Not a Burden. And it's a fantastic and authoritative account of the emergence of private capital into the landscape of debt in sub-Saharan Africa. So these three panelists, I think, all are going to bring a great perspective on the issues we want to discuss today. But you'll notice that, in a sense, they're all on the creditor side, all on the lender side of the discussion. And I had tried rather hard to get voices from the other side, from the borrower or the debtor side. And I had lined up two exceptionally good members to join our panel, but both of them, unfortunately, had to cancel precisely because they're up to their eyeballs dealing with debt negotiations at the moment. So we weren't able to get them, but I'm hoping that there are voices in the room that will challenge this kind of creditor side view of the challenges facing the continent in terms of sovereign debt and sovereign debt management. So the second point is, you may have noticed that I've snuck into the title a little equation, which is probably the most well-known dynamic equation in macroeconomics, or at least for the small open economy. And there are a number of people in the room here today who know it extremely well, having been taught this last term. But it's not just for decoration purposes. I think it's a useful framing device for hopefully some of the discussion this afternoon. It's the famous equation for the dynamics of external debt, or debt to GDP. Let's call it sovereign debt in this instance. And it just says that the growth in the debt to GDP ratio is increasing in the interest rate, the cost of capital. It's decreasing in the growth rate, so it's proportional to the difference between the R and the G term. It's a function of the stock of inherited debt. And the final term on the end is the primary fiscal surplus. And we can think of this as describing the evolution of debt, or we can take this sort of relationship and flip it on its head and say something about the degree of fiscal adjustment that countries may be facing, given the inherited debt stock, the underlying growth rate, the cost of capital, and so forth. And I think that's quite a useful way to shape our discussions around debt. And to set the scene, I want to kind of use this as a way to frame some of the comments that Abebe made yesterday in his keynote address. And he talked about this story, the narrative arc over the last 25 or so years, that kind of kicked off with actions that saw a reduction in the inherited stock of debt. The HIPC and MDRI debt relief initiatives in the early to mid 2000s, which coincidentally happened just before the real booming super cycle for commodities, the period where global growth was being supercharged by rapid growth from China, where the cost of capital was low, And the debt dynamics were extremely favorable. It created space for countries to borrow, increasingly from new creditors, both private creditors and what sometimes referred to as non-traditional creditors from around the world, essentially China and other non-DAC members. And countries enjoyed a huge investment boom, lots of it financing infrastructure, on the back of this powerful growth of domestic economies, favorable fiscal circumstances, relatively low costs of capital. But even before COVID hit, these debt dynamics were starting to turn less favorable. Growth was slowing down, the cost of capital, or at least the risk premium that countries were facing was rising. Fiscal conditions were deteriorating in many countries across the continent. And so even by about 2019, if you look at one of these classic indicators, the countries that are classified in debt distress or in high risk of debt distress, that was coming up to nearly 45% of all countries in sub-Saharan Africa before the COVID crisis hit. The COVID crisis, the consequences of the crisis, the macroeconomic consequences of the crisis for the continent, which Abebe described yesterday, plus, of course, Russia's invasion of Ukraine and the knock-on consequences that has had for the global economy, have made this situation even worse. And the latest numbers that produced by the debt sustainability analysis teams in Washington suggest that the numbers are now closer to 55-60% of low-income countries either in debt distress or at high risk of debt distress. So there's a serious challenge about the management of external and sovereign debt more generally. But I want to close my opening remarks with two observations, both picking up from the discussion yesterday. The first is what I'd call the Groundhog Day comment. Somebody somewhere down in the front here said, but we've been through all this before. Is this just not exactly the same cycle of debt accumulation, crisis, methods of debt forgiveness, rescheduling, etc.? Is it just a repeat of something that's extremely familiar from back in the 80s and 90s? And in some sense, the answer to that is yes. That compared to the 80s and 90s, this equation hasn't changed. The reality of the budget constraints, the debt arithmetic, is utterly unchanged. But in other respects, the landscape has changed very significantly. And I'll just pick 3 points. The first is the mix of creditors has changed enormously compared to the kind of debt crisis that we've studied in the late 80s, early 90s. The second is, and as a consequence, the challenges of coordination between creditors are much more elevated than they were. That, again, if you think about debt and debt restructuring and the negotiations around the coordination on debt restructuring, it was essentially a conversation that occurred within the Paris Club. The official creditors led the conversation. It's a much more complicated landscape today, and we'll talk a little bit about that later. But on the other hand, I would argue that one of the legacies of this last 25, 30 years across many countries in sub-Saharan Africa is that there have been very significant improvements in macroeconomic management, fiscal and macroeconomic management. And many countries have demonstrated that through what's been, in effect, a very solid macroeconomic management of the crisis of COVID and the subsequent events, that there's a resilience. And I think this resilience combines with what both Stefan and Abebe talked about, that the underlying resilience of many economies in sub-Saharan Africa is significantly greater than it was the last time we were discussing a crisis of this type. So, building on Abebe's optimism from yesterday, I think one could make a claim that while current conditions are extremely tough, and nobody's denying that perhaps the prospects for recovery and relatively rapid recovery are better than before. And the prospects of recovery with good macroeconomic management are more so. So I think we need to sort of keep this discussion centered on that. And one implication that follows from this is that it's very easy to sort of lazily talk about debt crises and think in terms of solvency and the like. Arguably, this is much more a liquidity crunch rather than a debt crisis. That the fundamentals of growth, the consequences of investment over the last 20, 25 years, make the prospects for long-run sustainability much more favourable. But there's no getting away from the fact that governments are facing serious liquidity challenges in the short to medium term. And that's really where I want to start by opening this up to the panel. So I guess my first question, which I'm going to ask Abebe and Rachel to respond to in whichever order you wish, is picking up on a point that Abebe raised yesterday, that on the importance, the catalytic importance of concessional finance, and in particular budget support and the ability for concessional finance to provide that liquidity. But if we agree this is so, then I guess my question to open this discussion to the panel is, what are the options for improving access to concessional financing, to scaling up the volume of concessional finance facilities from the fund, from the bilateral donors, from the multilateral development banks, and so forth? And so in a sense, what is the outlook from your perspective? So either Rachel or Abebe, who wants to kick off?
Shall I start, Abebe? Well, great to be here, and great to see you all. And I'm sorry I wasn't here for the whole conference, Chris, but I gather you've been having a great time. Listen, one thing I would add, Chris, just from what you said about the kind of optimism and resilience, I think it's also important to remember that we also had 2021 in that story. So we had the pandemic, we had the crisis, we had the shock. And then there was, I think, some sense of optimism in 2021 with countries starting to borrow more. And then, of course, there was the shock of the war. I think it's important to sort of think about those 3 years in that way when you unpack the numbers. But going to answer your question, there's a huge initiative that was kicked off in the G20 last year called the Capital Adequacy Review. And the purpose of that initiative is to challenge all the shareholders in the multilateral development bank system to what the review coins as stretching the balance sheets. And I think this goes to your question, Chris, about is there money in the system, and is it our own risk appetite that's holding us back from releasing that money? So there's a very nitty-gritty, detailed debate at the moment about whether we could, as shareholders, release more finance from the balance sheets of all the multilateral development banks. And in the UK, we've asked every bank to come forward with proposals. Now, most of those are banks that don't provide concessional finance. Yeah, they provide finance to slightly better off middle-income countries than the low-income countries. But in that mix is IDA, the concessional fund of the World Bank, and also the concessional fund of the Africa Bank, the AFDF. And we do actually feel that they are being kind of missed a little bit in this debate. The IDA balance sheet is actually way bigger than the World Bank's core balance sheet. And in the UK, we push very hard for that balance sheet to be used much more, actually. So not just more effectively, but more. We think that as shareholders in that balance sheet, we could take a lot more risk and get a lot more scale out of it. So we are going to be continuing to push that a lot during the rest of this year. So actually, I guess we think with the right, it's almost with the right accountants, Chris, that you can actually begin, it's not just policy, it's also people who will really get into the weeds of these balance sheets. You can begin to shift. And actually for IDA, it's critical, because if we don't, IDA has front-loaded, we're going to face a very big and very difficult financing cliff for the IDA recipients. And there's a decision for the Africa Fund as well to take about whether they're also prepared to take their balance sheet to the market and mobilize funding. So quite techie accountancy answers, but we do actually think that there's something there that we need to keep a spotlight on. And then on the IMF side, we actually feel that there are resources in the fund that could be released and made available through the concessional facilities for the fund, and particularly the gold. And we made a statement with France at the Sunak-Macron summit. Where are we last week? Week before, I've lost track. Calling on the fund and the other members of the fund to be willing to see the sale of some of the fund's gold reserves to put into the subsidy accounts at the IMF. And we think, so again, we do think with political will, there is quite significant finance in the system that could be mobilized through some of the concessional facilities. We also think that there's a case for the IMF to actually really step up its fundraising to allow the facilities that Abebe knows so well to grow in scale.
So I think that gauntlet has been thrown right in front of you, Abebe. You're welcome to pick it up. And let me say, rather than you having to say, that Abebe's speaking here in his personal capacity as a colleague and friend.
Thank you, Chris. Thank you. Again, good to be back. So a couple of points, perhaps. So the first one is, I think it's really important to understand how the institutions like the IMF or the Bank operate, of course. And, I'm a staff member there. And the staff overall, even management, at the end of the day, does what the member countries that own the institution ask us to do. So, the UK is, of course, an important voice, and other major shareholders are also very important in this conversation. And when they're pushing for us to look at, finding more resources internally, etc., the staff will follow. But just to be very, very clear, it's not our managing director, Kristalina, who's as engaged as anybody on this issue, or the rest of the staff that is not ready to do this, but rather the members that own the IMF that will have the final say. So that's a really very important point to make. If the mandates, the pushes for us to look at internal resources, we of course will do, or the other things like gold sales that you ask. But just to be clear, it's not for having not tried to raise more resources externally for the PRGT, our Poverty Reduction and Growth Trust. We have been for the last couple of years pushing to get more money so we can reduce the cost at which we lend countries, which for the last many years has been zero. So we've been asking, and typically the way the trust has been financed is through direct contributions from donor countries, and reflecting the rather difficult environments in most advanced countries who've been the main provider of finances right now in the wake of COVID and all the other economic pressures. There just has not been as much readiness to provide financing, and that's why we are running out of these concessional resources and not able to sustain the very strong and counter-cyclical support we had provided in 2020 and 2021. So, and again, when we are asking now, the pushback, and as Rachel is saying, is that you should be looking instead at internal resources. So something has to give. My sense is, as always in life, we have to strike a middle balance where an approach has to be found where there is some internal resources that have to be found, but also, of course, significant additional contribution is going to be needed from the members, the wealthier members of the institution, for us to be able to sustain this support. And the pitch I want to make in favor of directing more resources to the multilateral institutions is our ability to multiply the contributions and support a lot more countries than if a country was to provide instead these resources directly to another country. Because of our preferred creditor status, because of the way our institutions work, because we can, the resources that are provided to us, except the grant resources we need to pay down the cost of financing, can be counted as part of reserves. That's an easy way for countries to provide the resources to us, while still saying that it's part of reserves, for example, so that we can on-lend it using the strength of our balance sheet. So I think really very important issue. I suspect much the same type of factors are at work at the World Bank also. I don't know their balance sheets as well, but this is important. And then last but not least, one thing also the institution can do, again, it requires our board approval, also is though to take on more risk on our balance sheet. The point, Chris, that you started making, that we remain, I think, at a point of radical uncertainty, not even maximum uncertainty, in terms of how this beautiful and really fundamental equation is going to evolve in not just low-income countries, but I suspect advanced countries also. We really don't know how much more debt tolerance there will be, what R is going to do either globally or in terms of the interest rates our countries face, or indeed the growth path. What will be driven by what happens to commodity prices and a host of other things. So we really are at this point of uncertainty. So every time we're doing these projections as to what's going to play out over the next 4 or 5 years, if we take the moment right now, it's very easy to be pessimistic. But my sense is that we will also rebound from this period of difficulty. And so taking on more risk on our balance sheet is also one of the ways in which we can support more greater countercyclicality.
Okay, thank you. There's a couple of points there that we might come back to later, but I just wanted to pick up one other theme on this, and then I will turn to Greg. What we're seeing at the moment is in addition to this pressure on what might be called conventional financing for stabilization, there's a lot of pressure to be lending into adaptation, mitigation, climate change related finance. And there's, as people may know, there's a new facility at the fund called Resilience and Sustainability Trust, which is designed to provide concessional finance to support investment in adaptation and mitigation. To what extent is that complementary, and to what extent is it substituting and crowding out the kind of the finance for urgent stabilization needs?
So one of the things, again, there's this view that the pandemic has been all bad in terms of fostering global cooperation, multilateralism. But I do think that this is one of the ways in which the world came together. I think the common framework also was an instance. I mean, it has issues, but for the pandemic, I'm not sure we would have had that kind of structure. But the RST really is a case of where the world stepped up to try and provide additional resources. And there is, I think almost totally it's incremental in terms of the way it is working so far. So what happened with the Resilience and Sustainability Trust was there was a big SDR allocation. This is the IMF's currency, as it were. I mean, it's our way of creating liquidity at times of global crisis like the one we just had. It was a big issuance to all our members done in 2021. And out of this allocation, and typically what happens when this allocation happens is that, the poorer countries take this allocation and then swap these SDRs for dollars, pounds, yen, and start using it immediately. Advanced countries have no need for this allocation, so they just add this to their reserves. And, again, with, of course, G20 political support and the really forcefulness of our managing director, there was an agreement to on-lend a chunk of the SDRs that would otherwise have sat in the reserves of advanced countries, back to the IMF, so that we can on-lend it to countries to help meet their climate adaptation goals in the case of most African countries, but also other countries that have more mitigation type challenges. So I don't know, I think we're about at 45 billion in terms of where this trust is, and almost all of it is incremental. Okay, so I think at least in the case of this RST, it's incremental, and the way it works also is to make sure that it works hand in hand with our other lending facilities. In Sub-Saharan Africa, we had the first RST with Rwanda, which was approved by our board in December, and the existing program we have with Rwanda and the policies that they're going to be putting in place under the RST to strengthen how they improve their economy to resilience are going to be, they're designed to dovetail with each other. An exciting moment, but again, the goal was to get 100 billion, and we're only at 45.
Right.
So again, this is another relatively cheap way in which way more could be done. The UK, of course, has been one of the first contributors to this.
Do you want to add anything on that?
Yeah, I think it partly goes to what Abby was saying about the wider membership of the fund. I think we would say that, no, absolutely right, and congratulations to the fund for setting up the RST. I think the key issue remains the quite narrow group of members of the fund who have been willing to support both the RST and the wider facility for low-income countries. And I think when I spoke earlier about, needing to really think about fundraising, I think it was more to the point that, I think when we think about the fund, we think about the fund in its sort of global safety net, financier of last resort, and yet the facilities for low-income countries are basically voluntary. Mm-hmm. Yeah, the funding is voluntary. And I think that goes to my point about fundraising, which is that it's quite a narrow set of members, and we are one of those. But there's something that feels, I think, something that we need to think very carefully about in the international architecture when the financial safety net for low-income countries is basically funded on a voluntary basis, as opposed to the wider fund, of course, which is a membership cooperative. And I think that's the piece where we really need to think very hard. And it's not something I think that will happen overnight. But if you're thinking about long-term reform to the architecture, at what point do you actually think about a fund architecture that's funded with the concessional facilities funded by the full membership? And that's a long way away. But I think it is something that's key. I think the other piece is, from the borrower's point of view, do they feel the trade-off? And I think there are potential concerns about the quota limits that the fund puts and how the limits get used up by the RST and the other facilities together, and whether over time that might mean that borrowers do have to start to ration between the two because they've used up their cumulative limits.
Okay. I hear what you're saying, but just to clarify, the RST borrowing is not included in the normal access limits. So it's incremental, additional. Mm-hmm. So at least the near-term trade-off doesn't exist.
Good.
Okay. Thank you. You may want to come back. We will be opening up for questions after the first round of comments, but you may want to come back to any of these issues about that sort of low-cost concessional funding from the fund and the multilateral development banks. I want to change tack a little bit and turn to Greg, who, as I introduced, is a real authority on understanding the evolution of the private capital markets, sovereign capital market in sub-Saharan Africa. And a sort of two-sentence summary of that is that more or less after the first big round of debt relief under HIPC and the MDRI, a number of sub-Saharan African countries found themselves able and were encouraged to go to the Eurobond market to raise market finance, non-concessional finance. And we had a period of 10, 15, 20 years of very substantial borrowing that was designed to finance, in the main, significant capital formation on the continent. So there was what might have been called a kind of a Eurobond boom era, but it's highly pro-cyclical. That's the nature of markets, are highly pro-cyclical. And we're in an era where enthusiasm has appeared to have weakened, and possibly very substantially, on both sides of the market, the borrowers and the lenders. And I guess I want to get your impression, Greg. Is that a fair assessment of what's happened? And if it is, what does it tell us about the kind of the role, the form, the function of private capital in supporting sustained growth and development on the continent in an environment that is intrinsically uncertain and risky, and possibly more so, even to the point, as Abebe said, has been radically uncertain?
Right. So where I'll start is, if we were here in, say, the late 90s, early 2000s, we'd have maybe seen a lot of papers on aid effectiveness. People were talking about how we can shift the aid modalities to give countries choices, how we can go from these projects to budget support. And not only that, there was an Economist article around that time that said we were going to quadruple aid to certain countries that were in sort of, what was the word, good policy environments or something like that. And that was all the vogue in that time. And we had the debt relief battle had been won, and the 80s, the tough lost decade, was kind of put behind countries. And there was going to be this new era of choices. But unfortunately, those choices didn't materialize from ODA. Aid kept going, but countries grew really well. So it became a smaller portion of their financing and a smaller portion of their GDP. And that's the success of African economies after some of these rounds of debt relief, that they started to grow again in the 90s and 2000s. And if we think of the 80s and 90s as being about decades where dreams are broken, independence dreams are smashed, there are no choices, we can look at the 2000s and going forward, where countries had a lot of choices. And what we didn't know back then was that these new ways of borrowing were going to come on stream so quickly. If you read the Commission for Africa documents of 2005, there's not one single mention of Chinese lending to Africa of any scale. It started with a few big stadiums, football stadiums, Olympic stadiums, and scaled into railways, it scaled into dams, it scaled into large amounts of oil credit for countries like Angola. We had huge amounts of remittance flows coming from really bright Africans who have gone around the world finding jobs and sending money home. We had an inflow of FDI. And then we also had this start entrance to the markets. Bonds went away in the 80s as all the LATAM countries had defaulted many decades before. And they came back in the 1990s in the form of Brady bonds. And people started trading emerging market bonds again. So suddenly imagine if you're the Ghanaian finance minister in 2007 at his debut, or the Rwandan finance minister in 2013, the Kenyan finance minister in 2014. You've just sat through a long aid meeting, and there's all these conditions, there's temporary process actions, and you've got to do this, that, and the other. And if you do all that, we're going to disperse $30 million. And then the next day, you get on a plane. And one of these banks take you round, you put on your smart suit, you go to New York, you go to Boston, you come through London, and suddenly you've borrowed $1 billion within 24 hours, and you can do whatever you want with it. The pride, the excitement, the opportunity this brought was incredible. And I think that pride and choice is really important. But on the flip side, these loans have been quite expensive, and the market hasn't disciplined their issuance. So when the market's bubbling and everyone's happy, you can come and do whatever you want. But that stops, and we have these sudden stops that are well studied in the academic literature. So we've had these opportunities, but we haven't had the discipline. And so the way I sort of try and break things down is that, talking about Africa is a real struggle, 55 countries. So I kind of think about emerging Africa, and that's a country with a double B credit rating, nearly investment grade, and that's Morocco or South Africa. And Morocco, 2 weeks ago, I met the Minister of Finance in London, and a day later, they borrowed money, even in these tough markets. Doesn't matter. they can borrow just a little bit more expensive. And then in the middle, you've got these frontier markets that really have to wait for the right moment. And that's countries like Senegal, it's Rwanda, it's Cameroon, it's Angola, it's Nigeria to some extent. When markets are bad, you can't have any money. When markets are good, you can have money. And that's the way it goes. So that cyclicity exists. I don't know how you stop that and shift to a world of moderation. I think more about how countries can try and deal with that volatility rather than wishing that pro-cyclicity away. And so you kind of have countries that have done well and have used this money well. We've seen massive improvements in infrastructure, in social dimensions, in poverty reduction. And we've got countries that have simply borrowed too much and have already defaulted or are in fear of defaulting in the next few years. So we've got this whole spectrum. And the one thing I'd like to say for these frontier countries is the analogy I had in, say, 2016 to 19 was that we were driving sports cars down dirt roads full of potholes, pedal to the ground, borrow and spend, borrow and invest, borrow and spend, without any real clear indication of how this was going to end. It was about political cycles. It was about just keeping things moving. And then when COVID hits, and then we have a really bad 2022, the markets have soured, and suddenly you can't come back and refinance. And we've got this headache over the next few years, where we've got a number of countries that need to come back to borrow money to pay back past debts, but they may not be able to. And that's the headache we have. So we've got this call for more concessional financing, more financing to sort of help in this difficult moment. And then we've got this struggle about the way countries borrowed without any flexibility if times get tough. And markets have been horrific this week. It's probably one of the worst weeks I've experienced in the last 5 years. But the US 10-year is about 3.5%. So it shows that the market thinks we'll get through this. During the real boom days of the Eurobond, the US 10-year averaged about 2.4. So we're only about 120 basis points above that. So it's still possible for an African country with the right macro, with the right story, with the right investment to come to market, I think, over the next 5 years. But we do need to sort of set up a system where countries sort of borrow much more smartly. And that's where, like, the conversation's gone in terms of the sustainability, climate adaptation, climate mitigation, renewables, a much tighter use of proceeds. Because just before I finish, I think when I think about these debt crises country by country, I often see investment problems. If that money had been invested well, maybe we wouldn't have had the debt problem. And sometimes it's a revenue problem. We've had this massive growth in the informal sector. The country just hasn't generated the revenue in order to carry a decent amount of debt. And with these, they're really hard to solve, the investment problem and the revenue problem, but countries are working on it. So I kind of do see a way out of this. But it's inevitable, I think, that some countries will have to restructure. And, I think Portugal, the UK, France all defaulted many times in their history. And it would be a bizarre thing to say a country will never default. There's only a handful of those. And the tricky thing at the moment is Zambia's never really defaulted on this environment. Sri Lanka has never defaulted in this environment. And so they're learning as they go. And so while we had really fast restructurings in 2020 from Ecuador, who know what they're doing, they're a serial defaulter, we've had a lot of difficulty with both the new debtors coming, to a sudden stop and a debt crisis where they haven't got experience of restructuring. And also on the creditor side, we've got creditors such as China that have scaled up massively, who are also evolving and learning and sort of need to decide whether they're going to continue on a path of doing things their way, or we're going to have to sort of change the international setup so they're better integrated. I'll stop there.
Okay, thank you, Gregory. I think this sort of point about learning by doing in debt markets on both the creditor and debtor side is a really interesting one to stop for a moment on. I want to open this up for any comments or questions. There's another theme that I want to come back to on sovereign debt restructuring. But before that, can I open up to any comments, questions that people want to make? If you just raise your hand, we have a couple of mic monitors, let's call them that, who are going to follow around. So let's start here on the front row. And if you can either say whether it's to everyone or whether it's directed to anybody in particular.
Which makes me think that I work as very thematic areas. Recently, there's been a call for multilateral development banks reform, especially on credit access and faster disbursement of loans. And the worry is that the private capital sources from Eurobond and China are easy to get because they take short time to make a decision rather than the concession loans which take a long period and might not cover the budgetary time when they're much needed by developing countries. So what is your take on that?
Okay.
That we need reforms in a way that faster decision, less restrictions, and focused lending.
Thank you very much. Let me just see if there are any other questions up this side. Yes, in the middle here. I'll take maybe 3 or 4 questions and then we'll try and get some answers on these.
Hi, I'm Leticia from South University, but I'm from Ecuador and I worked at the IMF during the 2020 crisis. So I'm just curious if you had, magic wand, and you could, I would be curious to know your ideas of what other alternatives countries could have to finance their budgets. Because you mentioned, and then very bit, like how sometimes, going through the IMF takes us time, and we also know from experience how private funds can dry up so fast. They come to us at the start of the minute, they will close it, will collapse it, etc. So we're deciding the international financial system, and I'm just curious what the numbers think could be like the future, the first year.
Okay. Thank you very much. So I've got 1 and then 2 and then right at the back. So we'll take 3 more and then we'll stop there.
Thank you. I'm Heinz Garten with Woodward. I think it's very interesting discussion. So I guess there's been the debate about currency and its proportionate consequences and costs that that different countries may have. Say for example, one that maybe like dominant agreement, right? Right now is that maybe richer countries consume more, also consume more. Will have lessen the burdens and from currency for other countries, right? So from our research, we also find that global temperature also increase the poverty rate more in other countries in sub-Saharan Africa countries or in Southeast compared to richer countries. So and also from the we know that the pandemic see the exacerbate, right, and all the inequality. So I just wonder, from your viewpoint, what do you think? What is a good and fair, fair in terms of what the economic stand and the social inequality stand, right? So what is a fair allocation of responsibility, for the richer country, in the debate? And basically what richer countries achieve more, or what international organization can be more to make the cost.
Thank you. Thank you. So I've got 1 more here and then just at the very back.
Thank you. I'm Jonathan. I'm a master's student here at the University of Oxford. So my understanding of domestic private sector financing is it's largely from banks and still conservative. Like, pretty simple, how do we deepen those sorts of capital, and how do you start to see insurance companies, pension funds, and the like also investing on the continent within the domestic economies as well?
And then in this round, finally, just up the very back there. Yeah.
Thank you so much, Maureen. I'm here, a postdoc at the University of Oxford, but I'm also from Bangladesh, very much at the frontiers of climate change. So it was interesting to hear about the RSF, which is obviously targeted at the country level. I would be curious to hear more from the private sector side, so maybe this is a question for Gregory, about what the private sector can do to help create more accessible finance for innovations coming from the private sector, because I think a lot of the innovations around climate mitigation, resilience, and just transition is coming from that sector. And right now, if you look at those projects, they tend to be high risk, therefore the cost of capital is already quite high generally, but even higher for these kind of projects. So how can the private sector step in, or maybe work with the IMF or World Bank to create blended finance kind of options, and what's kind of being done in this area? If you could tell us a little bit more about that.
Thank you very much. I think that link back to the cooperation between the official and private creditors is really important in this respect, the sort of scope for blending and de-risking private capital in this area is extremely important. Okay. Who wants to dive in? How about I go in the opposite direction? Start with you. Is just anything that you want to pick up, Gregory, and then we'll.
Yeah, I'll first say that I don't think there are any magic wands or silver bullets. All of this is tricky, and I kind of feel that the global system of capital is deeply unfair. We've got many trillions waiting for people to retire, and few billions going to a continent. So that's the problem. For me, that's what it comes down to. It's an investment. It's a capital flow problem to solve, not really a debt crisis to solve. Because if we solve a debt crisis by cutting all the capital off, what have we really achieved? Because we've got these massive investment needs, whether they're social, environmental. So I kind of think that there's just hard yards involved. And what you kind of want to become is investment grade sort of, you want to transition like Indonesia has, like some of the East Asian economies, to where the bulk of their borrowing is at home and in domestic currency. So you cut out a lot of the original sin, the big, deval and exchange rate shifts that send your debt soaring in a tough year. And you're able to sort of raise money domestically. And one of the questions was about those sorts of institutions like pension funds, insurance. How do we get those sorts of steady, long-term savers putting money into public debt, which will supply better maturities and lower costs of debt? And it's really hard. And I think there's an element of chicken and egg in the sense that the country gets richer, people save more, and then these things grow. But there's an element of working really hard. And I think for lots of the countries we look at, you can certainly prioritize use of proceeds better. So, come up with your own pipeline of projects in advance so that when the capital's there, it can flow to one of those priorities. And maybe that then cuts down some of the delays that you talked about. And I think those hard yards of building those domestic institutions is massive because, too many rich Africans send their money and invest them in the US stock market. There's so much capital flow out of the and there was obviously illicit flows, but there's a lot of legal, people, I don't want that risk. I'm gonna save overseas. So if you can get a lot of Africans to save at home, that would be very positive. I think you can now, as a South African and pensioner, invest 30% of your pension overseas, and that tends to end up in developed economies rather than on the continent. So, just going back to my point of hard yards, but prioritizing public investment, systems that prioritize projects and the development of domestic markets.
Thanks. So I wanted to try and respond to a couple of the questions. So, one of the things I was trying to do in my speech yesterday, or at least, same numbers I quoted here, I use a little bit differently when I'm interacting with policymakers in the region, which is that, about 80% of public spending on development endeavors actually is financed by tax revenues. So that is by far the most stable, the resource that governments control, and the one that there is, continued scope to grow. So we shouldn't, if there is a magic wand to move, to create more space for governments to address their fiscal challenges, their long-term development challenges, that would be the one. Huh? I mean, and they can grow it gradually, and it's always a sign of a healthy society when governments are able to collect more revenue. So 80%, again, tax revenues, that's where a lot of work needs to be done. And then there's another 17, 18%, which is borrowing abroad, borrowing both from domestic and external markets. It can go up and down, but fundamentally, I think it's the other one that you want to rely on. And only about 2% is actually concessional financing aid. All that said, as I said yesterday, the external borrowing component is important because it also helps bridge the current account deficits that countries face. Huh? So, we should really always, as much as possible, people interested in public finance should have that in mind. A couple of things I wanted to react to, Chris, if I may, to the points Greg was making. You talked about ministers on planes coming to London. I saw many more bankers in Nairobi and Kampala, than I did ministers coming here. Of course, they did their roadshow before issuance, but I think the traffic was way, way more in the other direction. And this is because the private sector at the time was looking for a place to put their money. The only place where you could get yield, of the order of 7-8% was African bonds. So, the private sector has been getting a lot of reward, and the risk is coming now. So I think that's kind of really important thing. There was a lot of exuberance, a lot of appetite. There was a lot of supply side being driven, and many a country where ministers were saying no to borrowing. So it's not that they were indisciplined. I mean, absolutely. When cheap money is available and you have roads to build, schools to build, I don't know any politician that says no. They were taking it up, of course. And as I said yesterday, our leaders, our governments have agency. We cannot underscore that enough. But there is kind of shared responsibility here, I think, is the broader point I wanted to make. And then lastly, on the question on climate change, its effects on inequality between countries, within countries, and the broader issue of fairness. I think, honestly, this is one of the things that really vexes me. Yeah? So, Malawi, I think, people have never seen cyclones like the one that has hit southwestern Africa now. A cyclone that lasted a whole month. And almost everybody we've been asking is saying, this is exactly what climate change models were predicting. And so you have a situation where countries that are being most impacted are the ones in the global south, the least resilience, even if they're not being most impacted. If the frequency of these shocks is not increasing, the resilience to even normal shocks is very, very limited in these countries. And for all on account of something that they had nothing to do with, right? In terms of changing the global climate. And I think exactly the point that you said, the moral point, the fairness point also dictates more effort, more support, at least for the impact that climate change is having on countries. And I think that eventually ultimately was the argument that persuaded the donors to help create the RSD. But I mean, of course, that's a drop in the bucket, and the broader agenda remains untouched.
Thank you. Just picking up the point on tax, and you asked the wider question about what would we like to see in the wider system. I mean, there is a very specific issue in the international tax system that is not yet in the place it needs to be to support Africa, and that's the progress on what's called country-by-country reporting. The international policy to allow Africa to tax the tax base of multinationals who operate on their territory. It's there, it's agreed, and yet it's not working because it's wrapped around with some very difficult and some very high security standards. And since it was agreed in 2014, I think only somewhere between 5 to 7 countries have actually managed to meet the standards. So it's a slightly tangential point, but I think it's a very important point. If we're thinking about very specific areas where we can try and focus attention in this, exceptionally difficult year, that's certainly one that's at the top of my agenda. I think your question about are the multilateral development banks fast enough, and have we got the reform asks right? I think there are two parts there. One is just steady state, but the other is how they respond in the face of shocks. And there is a very live debate about whether the multilateral banks should have a kind of much faster fiscal facility, either that sort of almost twins the IMF, because they are cheaper than the IMF. That's just a fact, yeah. So you can have a pure architecture that asks the fund to do the thing the fund's asked to do, or you can actually build a sort of sister facility to the fund in the multilateral development bank system, just because it is cheaper, because of the way that they're structured and the way their capital is structured. So that's a very live debate. And then, of course, there's all the work on automaticity and prearranged finance, where the multilateral development banks have been making progress, but there's still a lot more to do. But I think we're going to come on and talk a bit about that afterwards. I think on the point about mobilizing institutional investors, I think I would say, and also local savings pools, I think I would say two things. One, there's been very good progress in the last year on efforts to try and credit enhance local African savings pools, so that those saving pools can start to invest in assets and infrastructure in their own countries, rather than necessarily always invest, as Greg says, abroad. But those are small, yeah. They're things that are going well but need to be taken to scale. And then I think on how do we attract the institutional investors and the pension funds, but try and attract them without bringing that very deep pro-cyclicality. I do think there are some things that can be start to make to work better, very much in partnership with the MDBs, actually. So, I think there are options increasingly now and structures for the institutional investors to co-invest at the same time as the MDBs. Some of the non-sovereign arms are beginning to create vehicles that will allow that to happen in a much lower cost and more straightforward way for the pension funds. And there's also exits. And one of the things that shareholders are asking of the MDBs this year is whether they can start to exit their positions a lot more quickly into pooled structures that the institutional investors can take positions in. And we are beginning to see that happen. IDB Invest, the Inter-American Bank's investment arm, private sector investment arm, is really leading the way there and thinking about new structures. So there is some quite innovative stuff happening in the pension fund institutional investor space. As ever, it's a question of scaling, and it's a question of scaling while somehow allowing positions to hold and not deepen that sort of pro-cyclicality.
I think I'd like to go back to the point that you parked in your answer about automaticity, and it's the sort of the general issue that debt contracts are dreadful for allocating risk. They load the risk on the debtor, and what we see is all these efforts to try and shift that risk back to the creditor are met with arguments about moral hazard risks, that this will undermine incentives to diversify, reform, and so forth. They'll weaken incentives for good macroeconomic management, for domestic debt capacity, if debtors feel that there's the risk has been passed back to the creditor. And that's probably one of the reasons why many of the initiatives to try and create sort of state contingent lending instruments have been unsuccessful in the past. Either that or issues to do with measurement and verification and so forth. But the corollary of this, of course, is that if the risk is all loaded on the debtor and shocks occur, crises happen, then everyone is thrown into difficult restructuring, bailout activities. And so I'm interested in what you think is happening in terms of the prospects for more efficient risk sharing in debt and debt-like instruments, either in the world of official capital or in terms of market instruments. So maybe we can just, that picks up on the point that you parked, Rachel, about the automaticity and essentially break clauses.
Yeah. So we've been doing a lot of work over the last year to really try and understand the opportunity in this space. And there is now there's a phrase that's out there called pause clauses or climate resilient debt clauses. And they're debt clauses that allow the borrower a break in service costs when a shock happens, most likely a natural disaster shock. And all the multilateral development banks have now been asked to look at the case for offering those to their most vulnerable clients. We're also encouraging the IMF to see if there are clauses that might be able to be built, for example, into the RST financing. The UK's Export Credit Agency announced at COP that they would start to introduce them in their own financing. And there's a lot of interest now in whether these can actually start to really gain momentum and be rolled out. The private sector has also worked on a term sheet, and the IIF has a term sheet that begins to set a kind of benchmark or a baseline for introducing them. The important thing about these pause clauses is that they're NPV neutral, which means that the multilaterals, particularly the multilateral development banks, could apply them without risking their preferred creditor status, and therefore they could play an extremely important part in the architecture that allows the multilateral development banks to take part in helping countries when shocks happen. Pakistan would have been a classic example. If Pakistan would have had one of these, then I think Pakistan's debt service externally was about 11 billion. I think the cost of reconstruction in Pakistan is often quoted at about 10 billion. I think they're very suitable for these sort of very V-shaped shocks. And Barbados has led the way, actually. So Mia Mottley, the Prime Minister of Barbados, talks a lot about how she designed these into her debt and how they have helped Barbados through particular climate shocks. But they're not easy, they're difficult. You have to work out whether they have automatic triggers, parametric triggers, or whether they're just what we call soft triggers, triggered by management. And there are examples of them being bundled with insurance or bundled with other forms of automatic payment by the MDBs. So you have a shock, you've got some prearranged finance, perhaps a catastrophe drawdown facility. That work allows you to sort of trigger with confidence, but also allows the triggering of the pause to be robust in terms of the modelling. But we think that there's a lot of mileage in seeing if these can't be rolled out across all creditor groups, actually.
I think this is really, really interesting, and it's something that I did a little bit of work on in the context of the Caribbean Catastrophic Risk Insurance Facility. But the big challenge facing small countries in that environment was the cost. These were very expensive instruments to carry on your balance sheet and to justify in public finance terms. And I guess I'm interested, maybe starting with Gregory. I don't know if you've been involved in this kind of discussion on state contingent finance or on these automatic clauses, whether you have a perspective on, I suppose there are two things. One on the market appetite, and secondly, I suppose on the prospects as a market like this deepens, the prospects for bringing the costs down to what might be closer to the actuarially fair price of risk in these contingent contracts.
Yeah, it's something that's been spoken about a long time. There have been oil warrants where the debt repayment changes on oil price for an oil exporter. We've had a long set of conversations on GDP-linked bonds, where if GDP went up or down, there'd be some change to the contract. The tricky thing is you need to be able to measure something, and you need to be able to measure something in a kind of fair and independent way, because the country could manipulate their GDP statistics. So you need to sort of be able to have trust in this. And there are numerous agencies that say a hurricane is Cat 6 or whatever. And so you can get that. So for some things, the data's already there. But the trouble then is you're an island, you've got this clause, and then you get hit by a pandemic and you default, because it's not the shock your bonds are set to be. So there's a complication of how do you have it for every shock that you might get hit by. And so we've got the practicalities of data. We've got the practicalities if you might get a different shock. And then if it's not all of your debt stock, then you're going to default on the 60% of your debt that hasn't got that as well. So you've got all these sorts of headaches. But I think the thinking's right. So I think for some countries where there is a shock and you can show that's the shock that hits debt most, and then that's right for them. But I don't think it's right for every country. And so what I like is simplicity. And I think whenever global finance gets complicated, I get very concerned because there's something dodgy going on. And I think if I can't understand it quickly, I don't like it. And so I like simple bonds that have clauses where if they're going to mature in 2030, you can call them 2 years early. So if we're going through a crisis, there's some way of just saying, okay, extend the bond 2 more years, and then we'll have another conversation. And if it gets to it, have a restructuring. So I kind of like simplicity because it's been so hard. The only way, Ukraine defaulted on its GDP-linked bond last year. And so they've just been really unpopular with the markets. And and then it touches on another point. We had this Belize blue bond, inverted commas. It was some secured loans, but someone has to verify that Belize is doing all this good work in its oceans. So these require external verification, and therefore there is a fee for that consultancy firm. So these operations are very good, but they are expensive. And I don't know how we bring the cost down unless it becomes like a global public good and something that, taxpayers in sort of donor countries are ready to finance. But yeah, so we need external verification and we need simplicity.
Yeah.
I can be very brief because the key points have been made. So just 2 quick points. I think one is fantastic idea. I think, particularly for natural catastrophes like, earthquakes, hurricanes, really, anything to help countries at that moment is really important. And debt relief is one of the ways to do that. So that's the first point, and I strongly support all the thinking that can happen. But the second, and something we shouldn't underestimate, is that governments also need liquidity, new fresh financing. Yeah? So it helps certainly that when you don't have to make debt service payments, but often, particularly to the MDBs, the amount of repayment due is not that much, and new liquidity is needed. A lesson that I learned, when the Ebola pandemic hit Guinea, Liberia, and Sierra Leone, they literally had no cash because tax revenues stopped as the pandemic happened. They closed down their economies, and ministers were calling saying, "Can you please, hasten how quickly you can disperse budget support to us?" And we were rushing to get money to them. So, I think at least at the IMF, I think I would rather it didn't come at the cost of new financing being provided when shocks hit, and because we are able to get money in budgets fairly quickly, retaining that option is, I think that we can help better that way than imposing debt service payments, which may or may not be falling due at the same time as the catastrophe.
I think it's a really, really interesting point there. On the liquidity premium in crisis is just so astronomically high that it may dominate some of these other activities. Can I, we've got about 10 minutes left. I want to see if there are any more comments, questions. There's one more issue that we might pick up, but let me open it up again. Comments, questions on, I think this last conversation in particular, I think is interesting about risk shifting and the challenges there. Or are people just getting tired with issues of debt and they're all thinking? Well, Stefan, since you spend a lot of time thinking about trigger insurance mechanisms. And is there anything you wanted to add in?
So actually to pick up, but I thought what's extremely useful because we are in. If the question is this time different, and I think Gregory were suggesting in the past we had lots of these conversations with commodity prices and so on. And the last thing you want to do is actually try to get the mean commodity price and calculate the variance around it. That's not the nature of the state of the series. But with climate data, we're getting more of these kind of data sets that actually are much more. So the verification and the independent verification is becoming possible. And I like the idea of thinking of the data, the verification part to be a public good, which we don't have at the moment. So you have all endless risk firms and also with all their models, but all that data is private because that's how the insurance company make their money. And the ambiguity gets then priced, as Chris was asking, actuarially, to avoid the actuarial fair premium. So there is real possibility if we can get more of that data out, then the innovation will well be able to follow, taking into account the simplicity as well. But most finance is complicated, so I don't think it's a straightforward complication to bring in. So that would be just my comment. Yeah. But there is a related thing then, is that it's the usual thing with anything to do with insurance. We can't insure income easily, so we'll have to do the components that are not correlated with any efforts. And then it's a matter of, are there ways of actually expanding that set? Because you don't need to have the independent risk, you want to have the joint distribution. So could we actually immediately think more about the joint distribution of some of these risks? And that will become another thing, even if we don't want to go income. If you get what I mean, is that, that it's the correlation that's the biggest problem for countries when stuff happens at the same time. It's rarely when one event happens.
Call's still open for comments. So since everybody's so young in the room, let me just say something about when these continue. This part of the room and this part of the room. That I remember the first time I worked in Zambia on something called the STABEX, the Stabilization Fund, which was designed by the European Commission, and the idea was very well defined, that it paid out when commodity prices fell relative to some measure of the long-run trend. And so I was working in Zambia, and they were trying to process the STABEX facility. On average, it took about 5 to 6 years to get a payout from STABEX, which is just about the same duration as the cycle. So just as the commodity copper prices were back up and rising, STABEX came through to say, here's the funding to stabilize your loss of export earnings. And that is the kind of the verification and the mechanisms that were admittedly particularly bad in the STABEX case. But it goes to Stefan's point about quick verification, and it goes to Baby's key point about liquidity being of such high value on a crisis. There's a question back here, Mohammed.
Sorry for just very naive question to Stefan and Chris. Why does it take 6 years to calculate the mean of a commodity time series?
I don't think it took 6 years to compute the mean, or even the deviation from the trend. It took 6 years to convince the relevant bureaucracy in the Commission that that was valid and triggered all the relevant steps required to get an agreement to consider the possible disbursement from the fund. It was a classic sort of bureaucratic lag problem. It was not a pure verification problem, and that's probably very unfair to anybody who works at the Commission here.
But the point remains the key one, which is what are the fiscal contingency systems that allow finance to be surged through them? I mean, how often do we look at the budget in this country? We have the budget and we have supplementaries. There are a lot of inbuilt rigidities that mitigate against fast action. So it's an important point to think about, and I think the sort of underlying theme of the whole conversation has been about building a shock responsive financial system as well as a financial system at scale. But that requires your finance ministry to also be engaging with some really, really quite difficult decisions and concepts. Maybe not as long as stomachs. But,
this is all the more important given the consensus, about volatility and also like much more shock-prone world we're living in, from climate to all kinds of other things.
Okay. Question.
I'm sorry to say I'm on the student economics for development, so very much student in the field. But sorry to take the question of the position side not yet. It was related to Greg's point on enabling domestic finance mechanisms and considering how to ensure that Africans will stay within the continent and everything. Taking it out of like an academic context, how would you say or how would you reckon you convince not only the policy for some of them having those policies in place benefits their personal finances, but convincing like an average Nigerian or an average Kenyan or an average Ugandan to have faith in economies that for some of them in their lifetimes will consistently disappoint their expectations from a non-economic point of view. So a lot of them just in an academic setting.
Yeah, I think the point Bobby made the other day was that half of African debt is domestic already. So half of the private investment in Africa is by Africans. And the trouble is, as the point was made by someone, I can't remember, it's a bit too much from commercial banks and not the long, steady savings in the pension fund. I think we've got slightly informal economies, so not many people have jobs that give them pension, so they're just earning week by week. And what my friends tend to do across the continent and the place I've lived is the minute they've got the house built, then they're thinking, maybe I should open a school, maybe I should put some bricks down and build some flats, maybe I should start a farming project. All of these side hustles are going on, but no one tells me I want some 5-year government paper in my savings portfolio. And in Ghana, for example, they've just done a domestic restructuring, and so independent savers have been hit really hard, not only by inflation at 53%, but the restructuring. So it comes back, and it's very difficult to convince someone who's lost their pension or lost their savings through currency movements to do it again. I think it's almost impossible. The only thing we can hope for is sort of better macro stability, and I think we do see variability now, but it's much, much better than it was 30 years ago when I sort of glanced through the World Economic Outlook. There's less, but you need some stability but at the same time it's kind of happening. Yeah, half of African debt is owned by Africans, right? So that's a start. But again, going back to my point earlier, which is it just takes a long time to build the trust in these institutions, and you just have to work at it every week and every year if you're in government.
Okay, we're coming close to time. I want to give Stefan a few minutes at the end just to wrap up. I know everybody is tired at the end of what, from my perspective, has been 3 fantastic days of the conference. But unless my colleagues on the table want to say anything else at this stage, I just want to thank the 3 of you for stimulating a great conversation. I thought there were a number of really important issues that came out of that discussion. I want to thank everyone here for attending at the end of the conference. I hope you found the session useful. And so with that, congratulations to all of you.